When selecting a mutual fund for the long term, it's essential to look beyond just historical returns. While past performance may provide some insights, it often benefits only those who invested before those returns were achieved. For example, a fund that delivered 100% returns in the past would have been valuable only to those who invested before that gain materialized. Instead, consider a comprehensive approach to evaluating the mutual funds for smarter long-term investing. This video will act like a checklist to guide your decision-making process. Over the past year, 9.7 million new investors have entered the mutual fund space. These new and seasoned investors are increasingly keen to track the performance of their portfolios. While the net asset value being declared daily on working days, monitoring mutual fund performance over both short and long periods has become more accessible than ever. Evaluating mutual funds based solely on returns can be misleading. Financial planners recommend looking beyond returns and considering factors like rolling returns, which provide insights into performance consistency over time. Comparing mutual funds with the right peers and benchmarks is equally crucial. For instance, a large cap equity fund should be compared with indices like the Nifty 50 or Nifty 100, not with mid cap or small cap benchmarks. Additionally, analyzing the expense ratio, risk metrics like beta and standard deviation, and the tenure of the fund manager can offer a clearer picture of a fund's overall performance. Benchmark and category comparisons are essential when analyzing fund performance. A large cap fund's returns, for example, should be compared against the other large cap funds and their respective benchmarks. If the average return for large cap funds over 3 years is 20% annualized and your fund has delivered only 14%, it's an indication of underperformance. Similarly, consistent underperformance relative to peers and benchmarks suggests that better performing alternatives may be available. A fund that consistently ranks among the top within its category is often a more reliable choice for long-term investments. The expense ratio of a mutual fund is another critical factor to consider. This metric reflects the portion of a fund's assets allocated to administrative expenses, and it can significantly affect net returns. While passive funds typically have a low expense ratios of around 0.25%, active funds may have ratios ranging from 1.5% to 2%. Over time, high expense ratios can erode returns, making it essential to evaluate them alongside other factors like the quality of the fund management team, portfolio churn, and volatility. Consistency in fund performance is a hallmark of a good mutual fund. Funds that perform well only in bull markets but falter during bear markets are often less reliable. Evaluating a fund's volatility and portfolio churn can also help gauge its suitability for different risk profiles. Conservative investors, in particular, may prefer funds with lower volatility and stable, steady growth over time. For long-term investing, a consistent performance track record is essential for achieving financial goals while minimizing risk. When selecting a mutual fund for investment, many investors tend to focus primarily on point-to-point trailing returns, often emphasizing the funds that have been top performers over the last year or so. However, this approach can lead to skewed conclusions. The main issue with P2P returns is that they can be distorted by 1 or 2 years of exceptional performance or underperformance. For instance, imagine a large cap fund, Fund X, that delivers a substantial 100% return in 2009 during a strong market rally. This outstanding return will significantly affect its trailing returns over 2 or 3 years, potentially making it appear as an excellent option due to spillover effects. But the real question to ask is whether Fund X has been consistently outperforming in the years before and after that strong 2009 performance. Many funds that perform exceptionally well in 1 year fail to sustain this performance in subsequent years. To make better investment decisions, it's essential to look beyond short-term point-to-point performance and focus on consistency over time. One of the most reliable ways to evaluate the consistency of a mutual fund's performance is through rolling returns. Unlike P2P returns, rolling returns help eliminate the bias caused by a single time period and provide a more comprehensive view of how a fund performs over various overlapping time frames. For example, using 5-year rolling returns with monthly shifts over a 10-year period helps to assess how a fund has performed during different 5-year periods, providing a broader picture of its performance consistency. By analyzing several 5-year rolling periods, you can better understand how often the fund has outperformed its benchmark index and peer category. If a fund consistently ranks in the top quartile or beats its benchmark in 80 to 90% of the rolling periods, it suggests a strong, consistent performance track record. Rolling returns offer a more nuanced understanding of a fund's performance than trailing returns alone. While trailing returns provide a snapshot of a fund's past performance over specific periods, example 1 year, 3 years, 5 years, rolling returns take into account multiple overlapping periods and can reveal performance trends that might not be evident from simple P2P comparisons. Funds with strong rolling returns often correlate with high ratings such as Morningstar's 5-star rating, indicating superior risk-adjusted returns over the long term. In contrast, funds with poor rolling returns are typically associated with low ratings, indicating underperformance relative to peers. A good fund manager goes beyond just picking stocks or assets. They develop a robust, well-researched investment strategy that balances risk and return over the long term. This means they not only analyze the present state of the market, but also anticipate future trends and adjust their portfolios accordingly. They pay close attention to factors like company fundamentals, earnings growth, and valuation, ensuring their investment choices align with the broader market conditions. In addition to technical expertise, emotional discipline is key. A good fund manager remains composed during market volatility, avoiding impulsive decisions that could hurt returns. They understand the markets are cyclical, and what may seem like a downturn could present opportunities for the future. This patience and long-term vision allow them to guide their funds through periods of uncertainty. Transparency and communication are also essential traits of a good fund manager. They regularly update their clients on the performance of their investments and are open about the reasoning behind portfolio adjustments. They are always learning, refining their approach based on past mistakes, and adapting to new market insights. Moreover, a good fund manager maintains flexibility. While they may have a core investment philosophy, they recognize when market conditions shift and are willing to pivot when necessary. This adaptability, coupled with a deep understanding of risk and a focus on solid fundamentals, helps them navigate through both bullish and bearish cycles effectively.
Stack Wealth is a new age investment management company that helps you take your wealth to new heights. Our team consists of experts with 25 plus years of experience managing investments for more than 1 lakh investors. Our team of experts help you curate a personalized mutual fund portfolio based on your goals and risk tolerance. They help you decide your asset allocation. They also help you identify high performing sectors to help you generate additional returns. And finally, we help you manage and monitor your investments in real time. First, download the StackWealth app from the Play Store or App Store and complete your sign up by entering your mobile number and email ID. Now you can explore the app, get your personalized mutual fund portfolio, or browse our various investment opportunities. To start investing, you have to complete your KYC. Once your KYC is completed, you can start investing in your personalized mutual fund portfolio or explore our expert curated investment opportunities. If you're not sure where to begin, your dedicated wealth manager will help you. Now you can start an SIP or make a one-time investment. Remember, you can always pause your SIP anytime and edit the SIP amount if you want to increase or decrease it. Finally, you can sit back, relax, because our wealth team will rebalance your portfolio based on shifting market conditions, identify and recommend new investment opportunities, give you monthly portfolio reports so you know exactly how your portfolio is performing. If you found this video helpful, don't forget to hit that like button, subscribe to our channel, and tap the bell icon to stay notified, because we are making finance and investing as simple as possible for everyone. Thank you for watching, and goodbye.